Hi, welcome to the Modern Savvy CPA and my next video, which I think that you all going to love. Now, most of my videos and all of my videos have come from either questions that clients are asking me or my own experience with the world and ideas coming forward. Now, my motto on home ownership is going to be the one thing that I explain on this video. And this one thing has several different parts and benefits. So the first thing is I believe that when you're paying rent, you're paying someone else's mortgage. So my philosophy is a home ownership is your number one and your first way of starting to build your wealth, because you want to be, there are many benefits of home ownership. One is you're able to deduct the interest on the mortgage, you're able to deduct the taxes, the property taxes you're paying, and then the third thing is you're paying down equity. So it's like a savings account. You know, if it's $200 going towards your equity, you're saving $200. Whereas if you were paying $1,500 in rent, you're paying $1,500 in rent, you can deduct it in nowhere else, and that goes to your landlord's pocket. So this is the reason why I believe that paying rent is paying someone else's mortgages. Now that's my first motto on home ownership. My second tip on home ownership is something called the Personal Residence Gain Exclusion. Now, in accounting world, it's called gain, but in the regular world, it's called profits. So there is the special law with the IRS. It's not a loophole. I do not like to call anything a loophole. It is something that is given to us with the IRS codes, and it's perfectly legal part of our tax codes. So it's called the Personal Residence Gain Exclusion. Now, in order for you to qualify for the Personal Residence Gain Exclusion, you first need to own your own home. Now, it could be a condo, it could be a townhouse, it could be a duplex, it could be a single residence. It just has to be your personal residence. So once you own your personal residence, you need to in order for you to be qualified for this gain, and I'll explain what the gain is in a little bit, is you need to be qualified, and you have to have two things that you qualify for. You needed to have owned that home 2 out of the last 5 years, and you need to have lived in the house 2 out of the last 5 years. With those two things, say now your house, you've lived in your house 2 years or 3 years, you now qualify with those two things. You've lived in it for over 2 years and you've owned it for over 2 years. And the market is so great, so you have equity now in your house. You bought it for $200,000. You have another $200,000 in equity. The market is wonderful. Now your house, you can sell it for $400,000. Let's say you can sell it for $400,000. Now, the great thing about the home personal residence gain exclusion is that whole $200,000, once you meet these two requirements, the ownership tests and the use tests, then all of that gain is potentially excluded from your income tax. So let's say that your net income from selling this house, after you sell it, because it's built up so much equity, is $150,000. You are able to deduct per person $250,000 per owner. So if you're the only one that owned the house, you're able to deduct up to $250,000. You're able to exclude up to $250,000 of the gain in this house from your income tax. That is tax-free money in your pocket. So that is a umpteenth reason that you should have start off your life not paying somebody else's mortgage, paying your own mortgage. So if you're a married couple, then and you own a house, you're able to deduct up to $500,000 of gain. So it's $200 for you and $200 for your spouse. So because you both qualify under these two rules. You've lived in it for over 2 years, 2 out of the last 5 years, and you've owned it for over 2 of the last 5 years, then you both qualify for this exclusion. So if you make $500,000 from the house, you can exclude the entire $500,000. That is tax-free income. It would be otherwise called capital gains. but it's not going to be capital gain. It's called the Personal Residence Gain Exclusion from your income tax. So it's one of the best ways to build wealth. The other part of this rule is there is no hard and fast rule within the IRS that says there's a limit on how many times in your lifetime you can do this. So let's say you qualify for that rule in your first house, and then you take the money, you buy another house. Your 2 years start up again. You owned it for 2 years, you've lived in it for 2 years, the market goes up again, you can sell it and make a profit again. You can exclude that gain again. There is no saying, I need to do this 20 times in my lifetime and it's over, or it's only 5 times in my lifetime. You can do it all your lifetime and make this gain without, and it will be excluded from your income tax. So that is one of the hard and fast, easy way to qualify for this gain exclusion. And it is one of the best ways to start building your wealth without having to with having your money work for you and not you working for your money. Yes, you work for the first part, but then you put it into work and it works for you. So that is my tip on home ownership. Always remember, when you're paying rent, you're paying somebody else's mortgage. So you want to be able to be one of the first things when you start working is having your housing pot, your housing bucket. That is the housing bucket, means your account that you're starting to save for your house. Whether you start off with a condo, like I said, or a townhouse, whatever it is that you can afford to buy first, it's your stepping stone to building your wealth and saving money and having it be tax-free. So thank you for watching this video, and I hope this tip was helpful for you. If you have any additional questions, please click on the link below, and I will be able to send your questions to me, and I'll be able to answer it in a future video. And if you like the video, please give it a thumbs up and watch me in my other videos so you can get new and exciting ideas on business and personal ways to save money and to have your money. You control your money and not your money control you. Because the main goal for me is, whether it's a business or it's personal, is for you to control your money and not have your money control you. Thank you.